What is going on, guys? Nick here, back with another video. Jerome Powell finally said it. Speaking at the Jackson Hole, Wyoming annual retreat with all of the US central bankers and economists, old Jay Powell loosened up his tie, traded in for a suit for a nice quarter zip, and he dropped a bomb, sending the market into a 750-point dip for the day. And that bomb he dropped is when he said that reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will likely be some softening of the labor market conditions, while higher interest rates, slower growth, and softer labor market conditions will bring inflation down. They'll also bring some pain to households and businesses. And while the market has basically done a surprise Pikachu face when he revealed this information, none of this is really anything new, nor should it be surprising. The Fed through 2022 has talked about pulling off the soft landing. Or in other words, can they get inflation under control without dramatically increasing unemployment? But the thing is, right now the labor market is extremely tight with about 3 to 4% unemployment. And because of that, a lot of businesses have really struggled to find workers. A lot of the restaurants around me have been advertising their actual pay rates. And if you watch the news over the summer, a lot of airlines have struggled to just staff their planes enough to meet the demand for the flights that they have. Now, I wouldn't be surprised if some of these tight labor conditions are actually helping to contribute to some of the inflation that we're seeing. Now, I remember not too long ago when a lot of people balked at the idea of a restaurant like Five Guys or Chick-fil-A paying their workers $15 an hour, saying, how could anybody ever sustain that? Those workers shouldn't be paid that much, that it's way too much. And now we see these companies not only willingly pay people this much, but advertising, hey, this is how much we pay, please come work for us, we desperately need the help. When you look at this chart showing the historical US unemployment rate over time, unemployment rates are almost never this low for any sustained period of time. So not only do I expect interest rates to go up, especially when the central bank is increasing interest rates and making cash less available for these businesses, but I actually also think that it might be better for our economy to function if the labor market isn't quite as tight. Don't get me wrong, I don't want to see any individual lose their job, but I do see rising unemployment as a trade-off when you're facing the inflation crisis that we're seeing today. Now, we have started to see some really solid signs that inflation might be at its peak and that maybe it's even starting to decline. Our CPI, or Consumer Pricing Index numbers, haven't seen any significant increase since the beginning of the summer. Oil and gas prices are finally starting to relax, and home prices have finally started to come back to earth with these mortgage rate increases, which I expect could have some impact on rent prices as well, but I think that'll take a little bit longer to happen. But we are sitting around 7 to 8% inflation, and just because it seems like we're around the peak, that doesn't mean that the Fed can take their foot off the gas. The current projections for inflation don't see below 3% until around the fourth quarter of 2023, which means that through the rest of this year and through the rest of next year, the current forecast is for prices to continue to go up at a pretty high rate, which means the Fed can't relax until we get much further along in this process. Now, the chairman of the Fed, Jerome Powell, says that he is still focused on making sure they hit that 2% long-term goal, and that they're taking forceful and rapid steps to moderate demand so it comes into better alignment with supply and to keep inflation expectations anchored. He said that they'll keep at it until they're confident that the job is done. He says that he still sees strong underlying momentum in the economy, which seems to match most people's perceptions. So while we have seen 2 quarters of GDP decline, meeting the definition of a recession, there are a lot of people out there calling this a technical recession. Inflation has certainly been tough for a lot of households to manage, especially those with less disposable income. But compared to what we saw in 2008, this feels like the economic equivalent of calling a hot dog a sandwich. We're sitting at 3.6% unemployment, and anecdotally, most people that I know are at this point living their lives like it's 2019 again. When I think back to 2008, that was a truly scary time. A lot of people were losing their jobs, a lot of people were taking pay cuts, and we're just not seeing that so far today. Powell went on in his speech to talk a little more about the structure of the rate hikes, and this is something that I've been wondering about. He said that there's currently no plan in place to pause or stop inflation hikes, which I think makes a lot of sense. But then he pushed back on discussion about what's going to happen next year. There's been some hedging in the market, or at least some expectation that after we get inflation more under control this year, that the Fed might ease off on these rate hikes and maybe even cut them a little bit, thinking that maybe after we've killed off demand, that maybe we feather some life back into it by just pulling back on the interest rates a little bit. But Powell said that restoring price stability will likely require maintaining a restrictive policy stance for some time. He went on further to say that the historical record cautions strongly against prematurely loosening policy. However, he did seem to say that the Fed should front-load some of the interest rate hikes, that they should be ripping off the band-aid quickly instead of slowly pulling it out and watching every little hair get plucked out of your leg. But those aggressive rate hikes, again, they're not going to come without costs. He understands that by aggressively raising rates, that this is going to cause demand to cool. And this slowing of consumer demand is going to cause a lot of pain for businesses and eventually unemployed Americans. In the 80s, when Paul Volcker was out here smoking cigars and squashing inflation, the federal funds rate hit a peak rate of 22%. And for comparison, right now we're at like 2.5%, with the current projections for us to hit about 3 3/4 sometime next year. And with all the pain that Volcker was putting the economy through, it was at the point where car dealerships were actually taking envelopes full of keys of all of the cars that they couldn't sell in their lot and just mailing it to them to show them, look what you're doing to our businesses. So while the market has reacted pretty strongly to these remarks that he made today, of course, none of these plans are written in stone, and I'm sure that the Fed is going to adjust to whatever actually ends up happening over the next year and a half. Will they take their foot off the gas if we start to see some economic pain but we don't see inflation come down quite as quickly? Probably not. Don't bet on that. However, if all along you've been believing that the Fed is going to be able to raise interest rates to get 7 to 8% inflation finally under the 2% goal that they have long term, and we're not going to see one of the tightest labor markets we've had in history of 3.6% unemployment rise, well, it looks like I've got news for you then. But the real question is, just how much is unemployment going to go up? Now, this is a stock market based channel, and I'm sure there are going to be a lot of other channels that are out there fear mongering this whole thing, saying that you should sell all of your stocks right now and that the market is going to tank and you should be waiting for the bottom. You're crazy to leave your money in the market right now. And somehow that they're so confident about what exactly the stock market is going to do before it actually does it, even though that if that was actually true and knowable that the stock market would have already done it by now. I think it would be silly to overreact and sell a bunch of your stock or try to wait for the market bottom at this point. If you are going to sell now and you're planning to wait for the economic conditions to improve or the market outlook to improve, well, I can almost guarantee you that the stock market is going to come way back before you're ready to buy in. I actually did an entire video about that and Warren Buffett's entire market timing strategy, so if you want to watch it, click it right here. And as always, thanks for watching.